quickly. Analog devices. So analog devices designs, manufacture, tests, and markets any software and subsystems that leverage high-performing analog signal and digital processing technologies. That was a lot just to say that manufacture systems. Um, Design and manufacture systems actually. But anyway, let's move on. The financial performance. So margins have been declining over the past 2 years. However, still above the industry average of about 18%, on average. 2021 is actually 18%, so it's performing more or less in line with the industry average. Now, the decline in margins can predominantly be explained by the havoc caused by COVID as well as the increase in competition. There is a lot of semiconductor companies. That is why I believe that in the coming years we're going to see aggressive consolidation, but however, increasing competition. Furthermore, now the rapid increase in costs, especially in 2021, costs have really ballooned. Especially in 2021, costs have really ballooned. Have really eaten into margins, and that's why we saw the fact that decrease. They have been decreasing, still above industry average on average, still in line with industry average, but they have been decreasing. That can predominantly be blamed by COVID-20 as well as the explosion in in, uh, in our costs. Now, R&D as a percentage of revenue has more or less remained below the industry average, but it has remained consistent. Right? Now, considering the margins have been declining and profitability has also been declining, you know, the fact that you're not at industry average does worry me just a bit, not too much, just slight. But considering that you're growing revenue shows me that your increasing costs is justified in providing return. Yes, net income has increased by 1%, and that will go along in explaining that the fact that most that is declining. But it's still in line with industry average. Costs are providing a return in the form of growth in revenue at 31%, which is very good. On average at 7%, slightly below industry average of 8%, but you can look at that. So you're just below industry average. So 31% growth in revenue supports my increase in costs. Yes, you are below the industry average, but one can say that Analog Devices is not really losing any track, especially in 2021, not losing any competitive or any market share. Because you are growing revenues at a massive rate. Your costs are justified because they're resulting revenue growth. You're gonna sacrifice bottom line growth just for a bit, just to maintain that, just to maintain your market share. So overall, not bad. A bit worrying, but not bad. So the decrease in the margins, the decrease in the margins, basically can be explained by the fact that revenues have been on the decline. Um, have been on decline, so we're losing market share. But like I said, there has been a massive bounce back in 2021, which shows me that you're throwing away any market share loss. So, the increasing cost to, well, basically satisfy customer demand, improve innovation, just so you don't fall behind from competitors and stop them from stealing any of your market share. The ROE, however, is below the industry average and it has been, well, deteriorating significantly. Whew. Now, again, that can be explained by the deteriorating margin. So that to me below industry average makes sense considering the margins have been declining. So a very bad sign for me. So the effect of profitability can be blamed on COVID a bit. But of course, one will need to consider the fact that competition as well has ravaged analog devices to a point where it has, in a way responded well. Increased cost, basically, starve off competition, improved revenue to a point where you can say that it's gaining and clawing back any lost market share. The financial position. So the current ratio below the industry average. Industry average is about 2.37. Below the industry average. So now considering the strength of the balance sheet, you could say AD, Analog Devices, strength is a bit weaker when compared to the industry. The margin decline has been improving. It has been improving, and this can be attributable to the close to $2 billion in cash that's really driving liquidity. It still, however, does have enough liquid assets. When you look at the ratio, it's still above one, almost close to two. So it does have enough short-term assets to cover short-term liabilities as and when they fall due. Now the asset test ratio, same with the current ratio, below industry average. However, it has been improving, so highlighting the strength of the balance sheet to improve liquidity, driven by the almost $2 billion in cash. Even though it's below industry average, I am happy with it. I'm not that disappointed, because even though we don't hold compared to the industry enough liquid assets in the form of current and asset test, the ratios have been improved, so there is strength in liquidity. I love the improvement. I love the levels that they're at. Below industry average, yes, but it's not so below industry average where one can say there is a definite risk of liquidity. No. There is a risk, but it is very small. All right. Now, furthermore, just back to the asset test ratio, it does show that AD does not hold significant amount of stock and in value terms or in dollar terms. So it is a pleasing sign, a positive sign of good asset management. It's a good sign of asset management. However, when we look at the inventory days, they are well above the industry average. Industry average is about just over 101 days, and they're trading at an average of 128 days. So it is worrying. The fact that you're holding on to stock for far longer than you. The more you hold stock, that will increase things such as the holding costs. That will eat into margins. That will increase liquidity risk in the fact that you might not have enough liquid assets to cover your liability. So it will make the balance sheet from a liquidity point of view less attractive. So even though in dollar terms it might not hold that much, which is a good thing, it does still hold a bit into it does hold a bit, it does hold quite a bit when it does hold stock for longer than the industry average, which does worry me. But why do you need to hold on to stock for so longer? Again, COVID can be blamed a bit because of supply chain disruption. The fact that you're not shipping out stock quick enough. So this you cannot ignore that. It is worrying a bit. It is worrying a bit. It does place a bit of burden on the balance sheet in terms of liquidity. The debt to equity, however, has dramatically improved. I mean, this is very good. I like this, and this will put less of a burden on the balance sheet considering the liquidity is not that good. I mean, it's not awful. It's not a catastrophic end of the world bad, but it is bad. It is pretty bad, you know. And again, depending on the kind of investor you are, you can live with it or you cannot live with it. I can to a degree live with it, considering you're growing revenue, your margins aren't that bad, you don't hold that much debt. So I can, to a degree, live with it. So industry average is about 126%. Your average is about 80's average is about 66%. So that is very, very, very good. Shows that AB has been strengthening its balance sheet by reducing debt. Very, very good. Now, cash position. Now the cash flow margin, so the cash from operations margin, has been fairly stable, above the industry average of 32%. Now, a strong indication of AB's ability to generate cash flow from operations, so ability to convert revenue into cash. It's a very strong ability, stable, above industry average. The sufficiency of cash flow margin has deteriorated, but a lot of it can be blamed to the fact that the fact that your debt to equity is at 38%. A lot of the situation is due to the fact that you've settled a lot of debt, you've paid off a lot of debt. I don't have a problem with it considering you have strong cash margin. So you've got a strong business model, that can convert cash from its operation. I don't mind that. I'm happy with it. You've settled a lot of debt. You've also paid off a lot of dividends. That will explain the situation there. On average, it's below the industry average of 0.844. Um, Again, mm, not I'm not gonna complain too much. Considering you paid off debt, you reduced debt to boost the balance sheet. Make the balance sheet stronger in the face of COVID and rising competition. So can live, you can live. So I can live with this. The low efficiency of cash flow. Can live with it. So again, you paid a lot to shareholders, but that can be basically attributed to the fact that AB does not want cash lying unproductively on the balance sheet. So rewarding shareholders is an effective use of it. An effective use of it. Again, considering there are risks, especially with liquidity. There are risks, but it's not a heightened risk to a point where it makes this company completely unattractive. So decent performance in my view. The PE at 46, above industry average, which is just over 40. Uh, Pretty decent. I'll have to say. So pretty decent. I'll have to say. So even though A does have a low sufficiency of cash flow, it's not a bad thing considering it has a high cash generating capability, which is above industry levels. Uh, yeah, you know, the decline caused mainly by paying off debt as well as rewarding shareholders, not having unproductive cash like on the balance sheet. So yeah, it's a decent company, but uh, not my kind of company. I mean, the performance is decent, but just looking at everything, taking everything into account. Yes, you got strong margins. Yes, you do have sufficient cash flow, even though there was a decline, but it can be explained. However, you don't have that much financial risk on the balance sheet because which is pretty low. Liquidity is a bit of a risk for me. Margins have been declining, but there has been enough investment to realize returns in the form of growing revenues. Yeah, I just expected more. So yeah, it's not my kind of company. Overall, it did underperform its peers in some metrics. It's still a good company, but I think I can get a better return somewhere.